I'm Mike Rich. In this presentation, we'll discuss how active investment managers can gain an upper hand by leveraging big data technologies. Before we look at how managers can gain from technology, let's look at their objective. Active managers are typically measured on their ability to outperform a predetermined benchmark and/or peer group over rolling market cycles. For example, a large cap blend equity fund may be tasked to outperform the S&P 500 index and/or a group of peers of similar investment mandate. Managers typically seek to outperform by conducting rigorous fundamental analysis where they pull apart and dissect a company's financial statements and then holds interviews with the company's management team, their suppliers, and competitors to gain greater insights on the prospects around an investment opportunity. Over time, these management teams have faced new headwinds, such as loose post-financial crisis monetary policy, markets becoming more efficient, and a greater amount of information and data accessible to these analyst teams. This is why today investment management teams must adapt and embrace big data to stay relevant. One way to remain relevant is to leverage more innovative and efficient economic data. Let's take a look at the Consumer Price Index, or CPI, which is a government measure of inflation. CPI is a backwards-looking index that tracks the price fluctuation of a relatively small basket of goods and services over time. This is typically reported on a monthly basis. Today, managers have the ability to leverage more innovative measurements of inflation. One example is the Billion Prices Project, or BPP's CPI. BPP's team, which hails from MIT, uses the internet to track daily price fluctuations from online retailers around the globe. Currently, BPP monitors in real time roughly 5 million products sold by 300 online retailers in more than 70 countries. BPP offers investors a better predictor of inflation because their information is in real time and takes into account broader data. This rather simple idea also provides investors with a better check on CPI numbers posted by various governments. Inflation data has a huge impact on a manager's view of a specific stock, an industry, or the overall market, and that is why having the most accurate and timely inflation data is imperative. The next two slides will show BPP versus two government CPI records, the government of the United States and Argentina. The first example is a US CPI, which is deemed as a fairly reliable source. You will see that these two figures track each other quite well. This doesn't hold true when comparing BBP to Argentina's official CPI. Argentina is a less reliable source, who has actually been censored by the IMF a few years ago for posting inaccurate economic data, including CPI. Where reliability is in question, BPP is a great alternative to lever. A second big data tactic to leverage are analytics that stem from real-time satellite imagery. A market leader in this technology is Orbital Insights, who has developed algorithms to count and measure objects such as cars, agricultural fields, buildings, and more to provide asset management teams, governments, and global nonprofits better insight and intel of the world around them. This could be useful, for example, in evaluating target stores. If we wanted to bet if Target can hit their quarterly sales estimates, one thing that could help would be to view how full their parking lots are nationwide during peak shopping hours. This technology allows one investor to do so. One of the more impactful and interesting examples of this technology is through the review of oil field production. Why would investors want to observe oil fields in real time? Well, like it or not, oil is the lifeblood of the world economy, and its price has great impacts on just about every region and industry around the globe. Let's see this in action. Here's a real example of what a provider like Orbital Insights can provide managers on oil field coverage. In real time, Orbital Insights can offer managers estimates on oil levels in each tank by simply looking at the shadows that cast across a tank's lid. The greater the shadow, the less oil is in the tank. This data is then quantified for the ease of client use, which allows institutional investors to use this information tactically in its portfolio management. This technology can report production levels faster than official reports, which most investors rely on. This timing advantage can be advantageous for getting ahead of the curve. The third and final technology tactic to discuss is for teams to employ quantitative models to do much of the heavy lifting. Today's level of data and information flow brings capacity concerns to the traditional manager and analyst team structure. Teams like Goldman Sachs Insight Equity team have built out computer systems that allow, for example, them to read over 26 million news articles, 1 million research reports, and nearly 300,000 earning call transcripts a year. Through these models, a number of query reports can be made, and these systems can better point management to areas of interest based on valuation, momentum, sentiment, profitability, or more. This can help to focus an analyst's attention to a particular market segment or individual security of interest, and it can also help teams to build greater conviction over current holdings. Overall, this technology can assist with both the return seeking and the risk management objectives of asset management. Couple discussion prompts. Which big data tactics surprised you most in my presentation? Do you think they can be useful in other industries? And do you think your current employer could possibly benefit from any of these technologies? And lastly, are there some alternative ways satellite imagery can be helpful for investment managers for achieving greater insights in, say, a particular industry, market, or a company?